Major global banks embark on epical shift towards sustainable real estate financing. In a historic realignment poised to fundamentally reshape the landscape of commercial real estate financing, major global banking institutions are undertaking a profound reevaluation of their lending strategies. At the core of this transformative endeavor lies a deep-seated acknowledgement of the environmental risks inherent in real estate assets and the urgent necessity of aligning financing practices with burgeoning green regulations. Central to this monumental shift is the European Union's landmark Energy Performance of Buildings Directive, EPBD, a seminal legislative milestone guiding financial institutions towards sustainability. Spearheading this movement is BNP Paribas, the preeminent bank in the European Union, which has committed to ambitious targets of slashing emissions intensity within its commercial real estate portfolio by potentially up to 41% by 2030. This bold initiative sets the tone for the industry, with banking titans such as Banco Santander S.A., Barclays plc, ING Group N.V., and NatWest Group plc swiftly following suit, either through implementation or exploration of analogous sustainability initiatives. This strategic pivot heralds a seismic departure in the risk assessment and mitigation strategies employed by banks. Commercial real estate assets, already grappling with challenges ranging from fluctuating interest rates to post-pandemic volatility in occupancy rates, now confront heightened scrutiny owing to the imperative of making sustainable investments to comply with regulatory imperatives. Roxana Iseu, Chief Product Officer at GRESB, a leading provider of environmental, social, and governance (ESG) data and benchmarks, underscores an escalating interest among banking professionals in navigating the labyrinth of new green regulations governing buildings. ISE emphasizes that regulatory signals are unequivocal, signaling a concerted push towards sustainability standards, a shift that reverberates across the entire spectrum of stakeholders, from equity investors to lenders. While the phased implementation of EPBD and analogous regulations unfolds over an extended timeline, the ramifications of noncompliance are already palpable. Buildings failing to meet green standards risk metamorphosing into stranded assets, rendered obsolete for sale or rental. EU estimates underscore the gravity of the situation, indicating that a substantial majority of buildings within the bloc, particularly those erected before 2000, exhibit subpar energy performance, underscoring the formidable challenges confronting investors and lenders alike. The magnitude of risk associated with noncompliance varies across jurisdictions, with some regions demonstrating comparatively higher energy efficiency within their commercial real estate markets. Nevertheless, even in these locales, a significant proportion of properties falls short of mandated energy performance thresholds. For instance, in the Netherlands, approximately one-third of commercial real estate fails to meet the requisite energy performance certificate level, accentuating the urgent imperative for infrastructure upgrades to align with evolving green benchmarks. This epical shift towards sustainable financing heralds a new era, one in which banks assume a pivotal role in catalyzing the transition towards a greener, more resilient real estate ecosystem. As financial institutions navigate this uncharted terrain, they must not only mitigate risks, but also seize the boundless opportunities presented by the burgeoning green economy.